Yeah, thank you. Let's say the topic of today's panel is relatively simple. It is a match between, let's call it the repo versus central bank liquidity. What is now actually the true source of financing within, let's say, in lots of ways, almost like in the developed world's financial system. And it's not necessarily a match. And I think in a way what we want to do today in the panel is just really to talk through what has changed in terms of the security, or basically in terms of the short-term financing market, what instruments are still in use, as well as, given the change in regulations, what are also some of the, let's call it market participants that are on the panel, they say what do they think they see changing in terms of their own business and their own business model. For that I have, let's say, Holger Neuhaus from the ECB, who will make an opening presentation with basically detailing the survey of the money market survey and the results as of the end of 2013. Then we've got David Raka from BNP Paribas and Carl van Buren from HSBC, who will then basically be doing on the follow-on discussions. So Holger, if I could ask you.
Yes, thank you. And I would like to actually also say that indeed, it's not really a match. I mean, the title seems to be inspired by the World Cup now, repo versus central bank. I mean, this is, I think, in particular in the euro area, this is not entirely true. And in particular, since also yesterday evening, I realized also of how many people from overseas are there. I would really like to say that for us, our operations, for example, there's always, I mean, everybody looks at how much actually are our facilities being used. But just to say, I mean, really to start from that, I mean, in the euro area, the central bank has chosen to operate normally in a liquidity deficit. So every week, always the banks have to come and get money from us because normally we are not buying securities. So, so the repo is a normal thing which is needed to finance banknotes and whatever banks have to fund in any case, and is out of choice by the central bank. But in any case, so going a little bit more into the groundwork, really. And the problem that we face actually when talking about money market developments, and I think it was also apparent in the discussions yesterday already, the issue is we do not really have the basis, or a very good basis, a very good overview, a statistical basis, so that it's difficult for us, for everybody to know what are we talking about. Because there's not really good statistics on it. So there are, of course, some good initiatives, whether it's the ICMA repo survey, but it's a survey and it's on repos. There's the initiative to actually do more on securities financing, as was mentioned yesterday. But this is partial. And also us at the ECB, we have actually been not so rigorous like we have been in other fields of statistics. And we actually also run a money market survey, which, we are running a money market survey, but also this is a survey. So I hope that you can actually see the chart on the screen, but I think the most important points I will mention anyway. So this is actually something, it's a voluntary survey. In this case, we have here a time series from, I think it's 104 banks actually, who are in the constant panel. Yeah, okay, thanks. So it's 104 banks in this constant panel, and you see of how the different segments are developing. So one of the things that you see here is actually that the unsecured market, which was mentioned yesterday, so that is really has declined over the last few years. The repo market is here the red segment. You see it has grown in importance. The survey is based on the turnover in the second quarter of each year. And in the last year, for example, the cumulative turnover reported by those 104 banks for the repo market was 30 trillion euros, so quite sizable. Above you have the OIS market, and here you have actually the FX, the swap market, which is also used for funding. So it shows really, one, as I said, the decline in the unsecured, and I will come back a bit later on it. And to be clear, it's the unsecured interbank. It does not mean that the unsecured wholesale is actually dry. And even behind this figure, there is actually there's still some important turnovers there. And also, contrary to what was said yesterday, I would also not say that the term market is dead, even though some of the figures at first sight may suggest it. But in any case, so the repo market is actually very strong. And of course, it's very, very useful to look a bit closer into what is actually behind those changes. And the one is actually to look, I mean, here I just look at the now the secured and the unsecured, always the unsecured interbank market. And what one can see now, this is actually based on a simple measure. We looked at those countries which in 2013 actually were not distressed, so we simply looked at spreads vis-a-vis Germany. And there you see for those countries, so from 2003 to 2013, there has been a steady increase in actually in the share of the secured as calculated by this measure, which is also what you actually saw, I mean, very consistent with what you saw on the slide before. If you look actually at the same measure for banks in countries which have been distressed again, as measured by bond spreads vis-a-vis Germany, you see that actually there was, I mean, this was a far less steady development, but in the crisis, and quite normally, I mean, much was shifted from the unsecured to the secured. Another interesting thing is, on the basis of the survey, is to look at the shares of repos. So what of the bilateral trades, as we have categorized them, has been done via CCPs. So here you see actually that, well, there has been an increase basically everywhere. In Spain is the red line. Actually, you see it's low and is even going somewhat down. I mean, I think those developments are also well known, but generally the CCP has become much more, I mean, has really gained much in importance. And I think that's also something one could also speak certainly more about in depth. But this is all just laying the groundwork, so to say. Another interesting thing is, what is the collateral that is being used? So what are the securities in the repo? And when one looks at, here in this case, I picked now from reports from banks in 4 countries, so Germany and France to start with. So there we see they have actually, so we asked them actually, do you use domestic collateral? Do you use euro area collateral? So other than domestic, or international? The international is now not shown in this chart, but it's only a small fraction anyway. So more or less, by chance, those figures add up to 100, more or less, that we have here. So you see that in Germany, domestic is 40, in the around 40%. In France, it's actually even less. So in euro area, collateral is then actually quite, the usage of that is quite high. This is different when you look actually at Italy and Spain. So that's also something which is very visible from the survey, and it also reflects then the holding in the securities here. So this was the data up to 2013, and all based on the volumes. I mean, the conference. I cannot show the 2014 data, unfortunately, but actually, since it's second quarter data, I mean, we are still in the process of collecting it, and hence we have that. Hence, they have the data just until 2013. But what we have here now is some things actually which is certainly more timely. So this is actually price data or rates. So this is overnight unsecured minus actually overnight repo indices. The green one is Italy. The blue one in this case here is Germany. Here's the zero line, and what you basically see is you actually have the repo rates being above the unsecured. There are reasons. There are certainly reasons for it, but I mean, among them is also the issue of who is trading and what has the unsecured market become, in particular the unsecured interbank market, because there we see actually this is. I mean, in the crisis you had seen the turnover going down, but basically there has been a selection. So that on the unsecured market, normally you would expect the unsecured market is more risky, but what we see is actually, it's in particular those who borrow who are perceived to be with very little risk. And hence everybody else, well, those banks, I mean also the ones with low risk, but certainly also the other ones, they actually have to make much more use of the secured market. So on the secured market, you have actually more influence from credit risk changes and so on in there and reflected. So that's actually an important, I think, an important finding which one has to look at. So the nature of the market has also somewhat changed, or the nature of the relative markets, unsecured, secured, and similar. I mean, for GC pooling, it's similar. I mean, also that occasionally trades actually trades above EON. Yeah. There would have been. I mean, I only learned late that actually Andrew Hauser was not coming, so I cut it short here, the structural one. Of course, there have also been now some other recent developments after after the rate changes, after the other measures which we have announced, where we could see actually, I mean, maybe we discussed that, or there would be questions from the audience afterwards, but we had seen, of course, quite some rate reactions. On the other side, volumes seem to have been rather stable at this stage. But that's something I could cover later on.
Okay. Thank you, Holger. That's a good introduction and sort of a good overview with regards to, in a sense, I think it gives a nice sense as the importance of secured, particularly, let's say, for clearly the more distressed banks within the Eurozone. And I think there's some interesting trends also with regards to the type of collateral that's being used. But before we dive into that, maybe David, I think from your perspective, given what you've seen in terms of your own business, the impact or the potential impact on regulations, was it that you see changing your business, and was it also you're planning to change in the type of business you're pursuing?
Yeah, well, thank you. Well, I think in terms of what's been impacting, first of all, the business or the market on a wide basis, just to recap very quickly. But as far as the supply is concerned, we've been hit very strongly by the new ESMA guidelines on UCITS and ETFs. So those guidelines, which came into force last year, as you probably know, but are requesting for much more transparency, both on notices and annual reports, are addressing the issue on fee splits. Are imposing much more strict collateral management guidelines, and imposing as well much more, let's say, scrutiny on the liquidity of the collateral which is received, and are as well addressing the issue about cash reinvestment. The two other topics which are covered by the guidelines and which are key are the issues around the ability of the buy side to reuse the collateral which is received, and that's very important, I would say, constraint within those guidelines, and the fact that UCITS and let's say generally funds can only enter into open trades. So that makes the business much more complex. And it, let's say, kills a couple of opportunities, obviously, for our clients. As far as Dodd-Frank and EMIR are concerned, I think there is much more awareness about the quality of the collateral and how collateral can be mobilized and how it can be used. However, the rules around velocity and around potential reuse of the collateral are making it sometimes a little bit difficult in practice to let's say, optimize the portfolios that we are managing on behalf of our clients. As far as the agents are concerned, I would say that we've been obviously affected by Basel III. I will not go into the details of Basel III because there was a very good roundtable yesterday for those who managed to attend. But agents are obviously impacted by indemnification, by fee splits, and by the definition of the leverage ratio. We are currently discussing, by the way, with the regulators on the fact that the European version of the leverage ratio is not aligned with the US one, especially by the fact that we should only account for our exposure in the leverage ratio if we offer indemnification to our clients, which the European Commission has not taken into account at that stage. We hope they will in the near future. Obviously, the shadow banking discussions and the paper which have been published by the European Commission are impacting as well the agent lenders on transparency, reporting to trade repositories, what kind of data are going to be reported and which way. Is it going to be aggregated? Is it going to be individual? And the debate around CCP. Cash reinvestment and debate around reuse and rehype are obviously very important for us as well, especially on how collateral can be moved from one account to another one. Well, the demand, I think, has been quite largely discussed since the beginning of the conference, but obviously Basel III is the main topic. Leverage ratio, LCR. I totally agree with what's been said this morning about NSFR. I think it's going to be the next big hit on our business, and it's true that if you take a simple matched book activity and you involve non-financial counterparts or clients, there is a punitive treatment, which is going to make it very difficult for intermediaries or agents to let's say, it's going to change the rules of the game, to be clear. And finally, about Dodd-Frank and EMIR, there's this whole debate about is there enough collateral out there? Well, when you look at statistics, there is 1,000 billion US dollar available or lendable assets on the stock lending market. I think the proportion for repo is 10 times this number. So on the paper, I think one could think that there is plenty of collateral which can be mobilized and that it will answer the needs of the upcoming regulatory initiatives. I think we need to dig a little bit more and look at what is really available when zooming on HQLA or even e-HQLA asset class, because it's very good to have plenty of corporate bonds or ABS available out there, but if those securities cannot be mobilized for regulatory purposes, it might be a little bit difficult. Now, market trends. So how does that translate into our business? Obviously, we see more demand for term trades. I think it's not a surprise. We see more demand for collateral upgrade on that one as well. I mean, this is the way the market is moving. Is there going to be a push on spreads? That's, I think, the $1 million question. But for the moment, it's true that the market has not anticipated this yet. My feeling is that when everything comes into play in real life and in real world, the spreads are going to be pushed up. Obviously, we see as well much more demand to refinance lower quality collateral, ABS, high yield corporate bonds, emerging markets, tier 2 equities. That's a trend because the HQLA are already mobilized on evergreen or long-term transactions. Generally speaking, a much stronger involvement from our clients into the product and into the business. The governance are being reinforced. And I would tend to agree with, let's say, the fact that at the moment there is no change on haircuts, floors. That tends to confirm what Dr. Hall said this morning. The anticipations at that stage are that the numerical floor, if they are confirmed in the FSB paper, might not be so punitive. So for the moment, I don't see anything on that field.
Okay. Thank you, David. Maybe one quick question. With regards to, let's say, the amount of emphasis that in the regulation has been put on, let's call it, the question of rehypothecation of collateral, and therefore the ability to offer non-rehypothecation to clients. Have you seen any uptake of that? Let's call it a regulatory, almost like request from the client side.
Honestly, I think there's still some debate, and nothing has been completely finalized as far as rehypothecation is concerned. I think the FSB tried to define reuse versus rehype by specifying that rehype is the transfer of clients' assets into another party. The European Commission is alluding to the fact that reuse of collateral can be accepted, but there's a couple of conditions, and especially a pre-approval from the collateral giver, that when they give collateral, they understand the risk that the collateral can be reused by the collateral receiver. I have the feeling that it's a concern for the regulators, because one of their issues is how many times can the collateral move. So this is the concept of velocity, and in case of fire sale or in case of stress, how many times the collateral has to be liquidated before it goes back to the initial lender, which is something I guess as an industry we need to realize and that we can understand. Now, in the interbanking market, and the fact that in master agreements collateral is transferred with a full transfer of proprietary, I think of ownership, I think it has to be accepted that when you move collateral in and out, there is a transfer of ownership, and the collateral receiver can reuse it.
Yeah, but to what degree have you seen, let's say, the collateral holders, so the ultimate owners, change their behavior with regards to which box they tick? Or is it too early even for that?
I think the collateral holders are trying to optimize as much as they can the collateral they have. And if they can use it, they try to use it as much as they can in order to optimize their costs and their needs. So I didn't see any drastic change as far as we're concerned. But
they don't see the same concern as effectively as the regulators did, or do. Yeah. Okay.
Certainly from a client perspective, at HSBC, I mean, we are seeing more and more clients ask that their assets are not available for rehypothecation. So they want leverage, they want to be able to trade. They like to place assets in a pseudo custody account where we have a charge over them, but they certainly like their assets to stay where they are, which clearly has a cost. It changes the sort of dynamic of the business.
Yeah. Okay, Carl, sorry, over to you with regards to HSBC and your view as to what that you have seen change in your own business.
Yeah, so I'm probably going to focus not at all on the sort of technical side of the regulatory change, which I think is almost the stuff we just have to do. It's not optional. It has to be done, and it has to be done in sort of various timelines. I'm going to focus a little bit more on the regulatory change that probably is a bit of a game changer, certainly for an equity principal or proprietary trader, and I think that will then impact the sort of rest of the market as well. And I think I'll sort of do a little bit of background perhaps as well. So if we sort of focus on what the regulatory agenda is, I think it's very much about de-risking and deleveraging the industry. That's what we're being asked to do, and that's what we're in the process of doing. And I think it's being achieved through three main requirements, if you like. Increased capital consumption, so all the business we're doing requires more capital to be put aside. I think in a equity finance Delta One type world, we're low consumers of RWAs and capital. Our transactions are fully hedged, they're collateralized, they're short dated. So we have a good return on capital, but that's not to say we don't have to sort of play a part in what the bank's doing to reduce capital consumption. We've then got the leverage ratio, determining how big our balance sheets are. And then finally, we've got liquidity ratio, determining how we fund our balance sheets. And I think when you look back historically, there's been varying measures that we've had to apply. These are not new concepts, but the way they're being applied today is actually a real game changer, certainly for an equities business, but I think for the industry as a whole. When we look at liquidity, there's two key areas. I'm sure we've heard about them all before, but the LCR, which focuses on funding for a 1 month time horizon. Banks already reporting their LCR, but have to be compliant to a degree not specified by the end of the year or 1st of Jan 2015. And then we've got the more onerous NSFR, which we don't have to comply until 2018. But I think the challenge all of the banks face is we look at regulation, we look at the implementation timetable, and we all like to front run it. We all want to be compliant way ahead of the days that the regulators tell us we have to. And so I think that adds sort of extra pressure onto the business. I think then when you look at an equities business, we have some real challenges, because fundamentally, when you run an equities business, you have no good liquidity. You have equity assets, which up until today are not classed as good liquidity. There's talk under the LCR that we may get some benefits for equity holdings, equity collateral, but today that's just not available. To the extent it does become available, then all banking stocks are going to be excluded from liquidity calculations. And banking stocks account for almost 25% of the market cap of the equity world. So if you knock out the banking stocks, you're at a huge disadvantage. And then equities will get something like a 50% haircut. So the actual real liquidity benefit we're ever likely to get is pretty minimal. So our challenge then is, okay, I may get some benefit, I may not, but how do I transform this business into a compliant business, into a liquid business? And I think, to sort of pick up on comments already made, collateral upgrade trades are how we achieve that. We take equity collateral, we swap it for ideally government bond collateral, again ideally in a 33-day term, because the nature of these liquidity rules, the liquidity you have has to be sort of perpetual by nature. So that's where the sort of evergreen nature of the business comes in. When we look at banking stocks, I have arrangements with a number of counterparts which just fundamentally remove banking stocks from my balance sheet, place them with third parties, either directly or through some sort of structured transactions that we do. And there's a whole variety of themes that all look very much the same, but they all very much achieve the same goal. And so that's the sort of real challenge in equity space, is how do you manage that dilemma? I think what we all have to be aware, though, is that whilst we solve that problem, we're actually just pushing that problem outside of the banking sector. We're putting it into other sectors of the economy, whether it's with hedge funds, insurance, assurance companies, companies that don't have the same regulation that we currently have. And I think we'd probably be a little bit naive if we believed that was always going to be the case, that we could solve our problems in that way. So I think that's something to sort of look out for. I think the other problem we are creating is we are being asked to put more and more liquidity in front of the business. It's a huge focus, but I think it will change the dynamic of the funding markets. And I think for two reasons. One, when I talk about evergreen funding, actually there are no evergreen funding benchmarks. You have to go and create evergreens by borrowing term money, longer term money. And naturally, at some point, that money, when it creeps under 1 month, becomes sort of fairly useless. But by the nature of always having to go out into the term to create evergreen, your long-term costs of creating liquidity, they move, and they move all the time. If you look back probably a year ago, creating liquidity was a very expensive proposition because the yield curves looked a bit different. They've flattened off a little bit today, which has made it cheaper. But as we look forward, if yield curves start to really steepen, then the cost of creating liquidity becomes more and more onerous. I think the flip side to that equation is arguably overnight money just becomes useless. It's valueless. And we have a lot of clients that wish to place overnight money with us because they want to be able to trade tomorrow if that's what they decide to do. But the value of that money really has no use for a trading, a principal organisation. I cannot deploy it in any way. And arguably, it's a cost drain. So if somebody gives me euros, potentially I'll place them at the ECB at a negative rate. I've got the bank levy, which is fundamentally a tax on the bank. So again, every time I take overnight money, the cost of doing so is just increasing for me. And I think that, again, could sort of really impact our markets and change the way the funding markets operate. Potentially, the overnight or the very short-dated space becomes valueless or at best a challenge. You combine that when you look at some money market funds, their regulators are telling them you must not lend money in the term. So you've got natural supply of cash where people are being told you can't lend it in the term, and then for banks we're being told we need more and more term liquidity. So there's a real sort of challenge that's coming in the markets. I think then when we look broadly at what's happening, without a doubt banks and the market is deleveraging, but I'm not sure that banks are actually de-risking. And if you look at the regulation as it stands today, we are being forced to remove low risk, low yield businesses from the balance sheet. They fundamentally just don't make the returns that we want to make. And we're taking those transactions off, and we're actually putting on varying degrees of higher risk transactions, higher risk, higher return, and we can justify deploying our balance sheets. And I think there's some sort of very good examples of that in the market already. If you look at the financials of a lot of the banks, you can see quite clearly over time they are reducing the balance sheet in their fixed income and their bond repo markets and deploying that into the equity space, where the returns are much higher, significantly higher, but the reality is the returns are higher because the risks are higher. So whilst I think we are achieving the goal of taking leverage out of the system, I'm not really convinced that we're taking risk out of the system. And I guess, where does this all take us? I think ultimately, when we talk to clients up until now, it's been about, what's the research, what's the corporate access, how do we introduce money to them so that they can grow the size of their funds. And I think the conversation now is turning much more around to how much balance sheet can you deploy for my business. And it's not just pure balance sheet, it's got to be backed up with liquidity as well. And I think that's how our market's going to fundamentally change. I think you're going to see balance sheet and liquidity becoming the key driver of relationships. Banks don't have the size of balance sheet to keep all of their clients happy. I think when you look at, say, hedge funds and their prime relationships, already they're under pressure where they can't pay all of their primes. So I think you're going to see one sort of consolidation, primes having fewer clients, clients having fewer primes, and I think without a doubt the cost of doing this business is going to rise materially.
Okay, thank you, Carl. I was trying to sort of in my head even trying to summarize it. I think it's actually quite difficult without sort of going back to what for me, I am a natural, I run a liquidity book for the bank's treasury. Within it, I automatically, liquidity is about, for me, finding somebody who can take my liquidity. And one of the big questions I always have is or at least that's my own personal lesson from the crisis, is you cannot depend on the market for liquidity. Certainly if you don't have access to a central bank. And this is ultimately what makes banks so special. They have access with good collateral to a central bank. Non-banks effectively don't. And what you're effectively describing me is therefore a system where it's actually becoming much more difficult to see how people can actually create a real short-term liquidity if there's no place to put it.
I think cash can become an issue at some point because holding cash now has a cost. Mm-hmm. Okay, because cash by definition and by nature is on balance sheets. So in the context of all this regulatory pressure, is how can you maintain your cash or manage your liquidity in a way that you can optimize your balance sheet. And I think the latest statistics on the repo market are showing a decrease of the market by 7%. it is 350 billion euro. Okay, so that's a huge number, but that's how the market has been moving year on year, 350 billion euro less. So the repo markets are going down, and we realize as well as agents, for example, that our clients are getting nervous with the idea of receiving cash as collateral, because when they receive cash as collateral, they have to do something with it. Yeah. They have to reinvest, and they cannot afford leaving a cash balance anywhere because it's a risk and because it's a cost. So we are entering into a new era, I guess, where there's going to be much more scrutiny around how we as agent or you as a liquidity manager are going to optimize the cash, because it's as well balance sheet optimization and management.
With that, can I just sort of get the first audience question then? Basically, question number 1. I don't even know where I can read it. With the ECB rate cut and marginal deposit rate facility entering into negative territory, do you anticipate short-term repo rates to either increase, decrease, stay the same, or I haven't got a clue, which is certainly the camp out the end?
Maybe you wish to clarify the level from which you start now.
Clearly, it's a difficult question because people take a long time. What is it? Decrease. Yeah. There's some logic to it. Decrease to, therefore, a negative level. But what happens, basically, and that, I think I'm not a securities lender particularly. What happens when repo rates go negative? What does that do to the incentive structure for all parties concerned? Does it make a difference?
I think a lot of the banks are struggling with the concept. So technically, can we do it? Yes. Yeah. But right across a suite of products to start moving your interest rates to negative rates is quite a challenging conversation with your customers. And it's difficult to see how that plays out. How does that translate? Do we have perhaps a different structure for the repo markets, perhaps versus deposit rates? Because I think as soon as that happens, if you allow an arbitrage to start appearing between your different products, then customers will take advantage of that. But I think it's difficult to see how this really plays out, especially if that negative rate goes further.
But from a lender's perspective, obviously, if the repo rate's negative and the rate and the curve is flattish, I mean, there's a really strong incentive not to go into the trade anymore. So the question is, what do you do? I mean, can you switch to a non-cash, maybe collateral structure, where actually you can offer or create a pickup for your client or not? And if not, obviously it's a concern, I guess, for the business, clearly.
Yeah, maybe an unfair question to Holger. What do you think the ECB is trying to incentivize with this?
Okay. I think I should heed my communications department advice. Who said that? Who actually said that I speak in my personal capacity here, which I think is translated into, if I say something different to what our president had said, you better believe him, not me. But actually, again, with the World Cup, I have to admit, I feel a little bit here like, tomorrow is Colina is here, so I feel a little bit like a referee at the World Cup. So
you can't get it right.
No, that I would not say. But actually, we prepared well. Yeah. We know the rule book. Yeah. We know pretty well, or we looked at carefully of how the players in the markets actually are playing. Then we took a decision, and now everybody's scrutinizing, of course, and that's implicit in the question, is scrutinizing now with all the video proofs and so on of what happened. And the funny thing is that even when you look in detail afterwards on the videos, you do not exactly know whether it was right or wrong when we get the commentators in the market. No, but more seriously, for us, I think central banks are really well known that if they, depending on the mandate, in our case, we are clear on the price stability and how we operationalize that. And we have always used actually interest rates to change it. So when we thought actually the inflation was too low, we lowered rates. So that's what we did now. I know that actually, of course, the negative rate is special. I think there can be discussions about it, whether it is as special as everybody says, or if it's special because we think it is special. It certainly is a unique point. It has not been done in a major central bank before. There will be some changes which we will also look into, but actually I think the behavior, I mean, where I'm also myself being on the money market desk, I mean, where I'm curious to see is how will the behavior change. I mean, maybe actually if listening to you, seeing some things in the market, it is cash seems to be a hot potato. So the question is, how is it now actually being handled? So is it just a narrow circle of players and assets and so on, where you actually are doing something with? In that case, it is that all those rates will actually go low, very low quickly. It is in part something we have seen. Another question is, I mean, you can also do it differently. You can actually also distribute it to a wider circle. Now, that may well happen. It's also, we have heard some signs, but in any case, I mean, we know from the crisis when lines have been cut, I mean, it takes a lot of time to readjust, and sometimes it does take some pain or rather some financial incentives to actually rethink those strategies. And it's typically not something which we see quickly, but we might as well see this. And then from that, I mean, we will see whether those measures lead, I mean, disregarding now our targeted LTROs, TLTROs, so disregarding those, we will see whether it actually leads to excess liquidity getting lower than it is now after the fine-tuning operation goes out, because people actually pay back some of the other funds. So that we will see, and whether it changes investments. But I think it's actually there. So there we have actually made our measures. Now we are also curious to see what will really happen.
Yeah.
I think it's certainly changed the shape of our funding book. So we already have a significant and material increase in the amount of sterling we have on the books. And now entering the FX swap markets to actually put that back into either euros or into dollars to meet our own funding requirements. So already you're seeing how it's impacting the shape of the books.
I won't dwell on this any further. In the sense that the other question I'm sort of struggling with, basically, as a natural cash provider, then how is it that one can actually still use, let's say, the repo market to invest in a secured manner, and particularly in a manner, probably in the maturities that nobody wants? Is there a point in time that I need to start to look at different counterparties?
Well, I think certainly the sweet spot is 33-day evergreen. Well, that's what we're willing to pay for. I'm not sure looking for different counterparties solves the problem, because I think this is going to become a structural change to the market because of the way the regulators are demanding we fund our businesses.
Yeah. But in that sense, to what degree, and I think there's a shame in that sense that Andrew isn't there, because that's one of the things he wanted to talk about, or he was going to talk about, let's say, what is actually that a central bank is looking for in terms of its own functioning of a money market. And in a way, let's say, in the changes in the rules, let's say, we've started to make a lot of changes. But have the changes really been made in line with thinking what it is you want to create in terms of the market you create? Or were a lot of them driven by what I call, let's call it the emergency measures of 2009, and now we're just in the execution phase of maybe not as well as an academically underpinned thinking about what it is we need to do as a whole?
Yeah, but if I can chip in there, I think that it is. So it's very tempting actually to think of that there's a conflict with all these. I mean, the regulations. I mean, do we want to have a liquid market, or do we want to have an overly regulated market? I think that would be a bit of a suggestive. it's a suggestive question.
Yeah.
So there's a point of, was there a need to actually do something? I mean, were the previous regulations, were they sufficient?
No.
And yeah, I mean, you said it, they were not. So that is clear. Then is there a conflict now, not between a liquid and an over-regulated market, or is there a conflict between a liquid and a safe market? At first sight, maybe, but I'm really not sure it is, because I mean, what is the usefulness even also for a market participant of something which looks liquid, but the first moment something happens, I mean, liquidity dries. I think we had that in the last few years. Yeah. Because the last crisis was not all on sovereign debt. I mean, I think there were some years before which were very exciting for everybody as well. So there's something needed to be done. So I think there is not really a trade-off between either liquid or safe, but actually I think it's something where one has to do something. Does it require adjustments? Yes, it requires adjustments. I mean, if I'm asking the question, I mean, do you want to have a liquid unsecured market and a very deep one? Of course, my answer is yes. If you're asking about do you want to have also more prudent cash management, I would say, oh yes. What does it require? Yes, maybe actually there is a shift from the unsecured to the secured market. Will it mean that actually it's less liquid than it was before? Yes. And it was very liquid, and I mean, some of the risk premia included in the market were at levels which I have difficulties to explain with the benefit of hindsight at least. So is it easy to set all the parameters in the regulations right? No, that certainly is not easy, and one has to work on this. And in particular, of course, it's difficult because indeed there was a view that, and not just the emergency, but also other things, that a lot has to be changed, profound changes. So many changes happening at the same time. So to make the places, the markets a safer place, so there are quite some adjustments, and indeed it's also a hassle inside central banks, inside the regulating community and so on, to actually make this work, make it happen. That also explains of why sometimes there are adjustments, like with the leverage ratio. Of course, I mean, when as a market participant, you look at the regulations, you're looking at, okay, what does it mean for me? How do I have to change my behavior? For leverage ratio, I mean, while we had a shift from the LCR, I mean, from unsecured to secured, the leverage ratio says, I mean, if you do low yield, hence, and then low risk business, maybe you don't really have an incentive to do this. So is there something? So there were some adjustments. So we are looking at the things, some adjustments were made, which is also, it's not cast in stone. One has to, I mean, you're also adjusting your book. If you have a view and you have a position, you adjust your position to see of how to fine-tune it. And that, for example, happened there with the netting, of course. I mean, also in our contact group on Monday, I think there was also some feedback of still, and also some things were mentioned yesterday here in one of the sessions. There are still some things which market participants think they could be better adjusted. Like, I mean, you don't know how to treat unsettled repos and netting and so on. So these things can be further looked at. I'm not promising you anything, but they can be further looked at to see of, do we have to fine tune. But the overall thing is not really a trade-off. Yeah. And so markets, I mean, should be liquid, but also they should be safe, and that requires a price. It's also, I mean, you talked about, yeah, I mean, there are more costs for actually the liquidity, yes. I mean, if there were not more cost, it wouldn't have made a difference. So that.
Yeah. Okay, Holger, thank you. And in a sense, thank you for the panelists. I think I've run out of time probably a long time ago, but just by not looking over my shoulder, I escaped for a long time. Is there room for maybe one or two questions? Unless
of course,
people
yeah, we have time from the audience for any questions for the panel.
Feel free. No.
Okay, I'm going to break the ice with a question, because Carl mentioned earlier that, and we've had a lot of doom and gloom today, or the perception may well be that way, but our business is a low capital burn business. It's collateralized, it's short dated, it's A1, P1 counterparties. That's got to be a good footprint for business going forward, surely, in a capital constrained world. I'd like to kind of get a general opinion on that from the audience, well, from the panel.
Yeah, I think absolutely. That's again, one of the key reasons that we're seeing balance sheet being committed to the business. It's fundamental to how the banks need to operate moving forward.
Fantastic. Anybody else?
Hello, Nathan Evans from Six Security Services. My question is about collateral mobility, and if the panel perceived that there is a single bottleneck that can be identified, and if so, is it operational and lies with the infrastructure operators? Is it due to the fragmentation of the market and that collateral is tied up with players which are not involved in lending currently? Or is it simply that it is financial and that the collateral value hasn't reached a level to bring online the potential collateral that there is available?
Collateral velocity, this is what is asked, right?
It's a tough one.
Very tough.
Yeah, well, from what we see on our side and from what I can share is I think the regulatory pressure about ability to transfer or move collateral is here. So as agents, when we talk to our clients anyway, I mean, today I think they all consider that when they receive collateral, they cannot reuse it. So actually, I mean, the chain is just blocked. And as I said a bit earlier, as far as the principal to principal or interbanking, if you want to call it, flows or business is concerned, I don't think there's going to be a lot of change in the short term, which means that collateral is going to be moving the same way as it is today. We are in a very let's say legally governed setup where collateral can be transferred. I think back to basics at some point as we transfer ownership of collateral when it moves. When you look at the account, if you have the securities and you are owner of the securities, you can deliver them. So that's just, it's a bit technical, but I mean, you cannot deliver collateral you don't have. So regulators should be as well, let's say, or should feel comfortable in the sense that we as players know what we do, and when we receive collateral, if we have the ability and the right to redeliver the collateral we receive, we should be able to do it. So that's the way we see it for the moment. I don't know if it completely answers your questions, but...
Okay, well, I think we'll draw the panel to a close. I'd like to thank Axel and his colleagues up there, so thank you very much.